Good morning, everyone. It's an absolute pleasure to be here today to talk about the outlook for 2025. And we really have started on quite a fascinating month so far. I've spent the last 2 weeks traveling over parts of Europe and also in London, meeting both our corporate as well as our institutional clients, talking to them about this very same outlook for 2025. And what's clear to me is that two key themes have emerged from our discussions. Pretty much everybody was focusing on two key themes or areas of concern, and they really partly relate to the reverberations that we are seeing from the US elections, the outcome of the US elections. The two themes that I want to talk to you about will be what's happening with the US Federal Reserve and whether it's able to cut rates further, how fast, how quickly, and obviously the impact for the rest of the world. Now, this is quite important. As you can see from this chart, we've been in a period of massive yo-yoing of market expectations for Fed rate cuts. These are the market-implied Fed rate expectations. In the middle of last year, in the summer of last year, markets were expecting very aggressive rate cuts from the Fed, almost 175 basis points of cuts priced in by the end of 2025. But as the US economy defied expectations of a slowdown, the labor markets remained strong. And as we headed into the US elections, and especially after the results came out, it was very clear that markets have very quickly priced out expectations of rate cuts. So currently, we're expecting only 125 basis points rate cut from the Fed. Now, this has pretty significant consequences for the rest of the world. If you can get money market rates, which are US money market rates at 4.5% to 5%, it becomes that much more difficult for other parts of the world to attract capital, whether it's into the equity markets or the bond markets. This chart shows you just how compressed the spread between yields of emerging market bond indices versus US money market rates has become. It's at the lowest level almost in the last 20 years. And really shows to you why the last few years have been challenging for emerging markets that are trying not only to attract FDI flows, portfolio flows, but also trying to tap international markets to refinance themselves. So if the Federal Reserve does not cut rates like we expect it to, then clearly that's going to be a source of challenge for emerging markets. But why are we expecting the Fed, or why are we even having this discussion of maybe the Fed doesn't cut quite as much, or it's only going to cut once? The reason really is the continued theme of US exceptionalism. The US has been extremely strong, a very strong labor market that has underpinned US consumer demand, and that has really helped buoy up US growth. Our own expectation is that global growth remains fairly unchanged from 2024 at a very benign 3% growth rate. So not too bad, not too hot, not too soft. But if you look at the underlying components or the regional components of this growth story, you can see that despite our expectation that the US will slow, US growth is still higher than what we expect for other major developed economies. And that's why the theme of US exceptionalism continues. And on this, if you add expectations that Mr. Trump might introduce tariff policies, and that's the second key theme that we have discussed repeatedly with clients. If you have this introduction of tariff policies, that is seen to be inflationary for the US economy. At the same time, President Trump is also likely to announce more fiscal stimulus in the form of tax cuts, more defense spending. Again, that buoys up inflation as well as your demand story for the US. So overall, the expectation is that the Fed might actually be more constrained than what we're expecting currently in its ability to be able to cut rates further. And as I said, that has consequences for the rest of the world. The US dollar will be stronger. Other markets will find it harder to go and find or attract capital. But the US exceptionalism story is not just a story about the US, it is also a story that relatively other parts of the world seem unexceptional, especially in terms of growth. If you're looking at the euro area, for example, we are not expecting a recession, though that came up very often in our conversations with clients. But really, it's a very weak growth story that comes through. And that's why we expect the ECB to have to do a little bit more of the heavy lifting in terms of cutting rates more aggressively than the Fed to be able to support growth. If you look at the euro area as a whole, we expect sub 1% growth for the entire year. There are obviously divergences within the euro area. Some economies are growing faster, but if you look at the major economies, especially Germany and France, they are really constrained by the political situation within their economies, which means that they don't really have that much leeway to be able to boost fiscal spending so as to offset any tariff impact that might come through in case President Trump does go ahead and impose tariffs on the European countries as well. So really, we have to see the ECB doing a little bit more of the heavy lifting. The Bank of England is in a slightly different situation. Growth momentum in the UK is slowing as well, but inflation is slightly stickier in the UK. At the same time, we have had a budget being announced that is slightly more pro-growth for the UK than similar budgets for the euro area. And so our expectation for the UK is for slightly above 1% growth, but still below that of the US. We also expect that the UK will not be so directly impacted by tariff wars. It will be able to carve out some sort of a negotiation for itself. But overall, the picture is one where within the major economies, the US continues to remain the strongest growth story and the most attractive story across all these economies. The key question then happens is, if the Fed doesn't cut, then clearly other central banks are constrained in how much they can cut because they need to be able to maintain interest rate differentials, defend their currencies, and that also obviously has implications for how much they can support growth. But looking at the other key theme that kept coming up besides the Fed rate expectations was what will happen on the trade front. Are we going to see an escalation in trade tensions again like we saw during the Trump 1.0? And here, I think while the US administration so far has started off with a very conciliatory tone towards China, we are of the view that most probably China will be at the forefront of any such tariff actions from the US. The reason for that is that there is quite clear bipartisan support for action against China. Bills have been introduced in both houses of Congress that look to revoke the permanent normal trade relations or the most favored nation status for China. And that will most probably be passed by the end of 2025, which will automatically raise tariffs quite significantly on China. But President Trump has already, during his campaign, been repeatedly saying that he wants to raise tariffs on China to about 60% on all imports from China. Now, our own calculations suggest that a 60% tariff would mean a drop of almost 70% in exports from China to the US. And that could really take off 2 percentage points of growth from China's growth story. Now, China is growing about 5% in 2024. A 2 percentage point drop is quite significant for an economy that's growing at 5%, and we expect that to further slow down to 4.5% in 2025. Clearly, China will have to have other offsets. Its own domestic demand story remains quite weak. There is a restructuring of the real estate sector that's ongoing that has actually led to a contraction of real estate investment by about 10% on average over the last 3 years. We expect that to continue this year as well, although at a smaller pace. And the contraction in the real estate sector is not only directly impacting GDP growth, but it's also impacting it through the effects on consumer demand. Consumer confidence is weak. People, as Abhishek mentioned earlier, people are actually saving up. They're not spending. So you've got a very weak domestic demand story. And what has really helped China has been the trade story. Almost 1 percentage point of growth last year came from net exports. China exported more than it imported. So if you have an escalation of trade tensions, that's a very significant hit that you could get to the growth story. What could China do? Well, fortunately, they have left some gunpowder dry. They can actually use fiscal stimulus. They can spend more on the government side. They can also cut interest rates. They can inject liquidity into the system. That will support domestic demand to some extent. But at the same time, China has also been diversifying exports away from the US. And I find the chart on the right-hand side quite interesting because I don't think a lot of people realize that now China exports more to emerging markets than it does to the US, the Euro area, and Japan combined. And this is quite a significant development, and we expect that this will continue over the next few years and maybe decades, where China continues to be at the center of rising emerging market trade. And that's why you're likely to see global supply chains reorienting, which will have implications for the shipping industry as well. Any direct tariff action on China has broader implications, obviously, for the rest of the world. Many countries now, if you see the chart on the left-hand side, I'm not sure how clear it is, but I can tell you, many countries now are more dependent on Chinese demand than they are on US demand. They're more integrated into China than they are into the US. And this includes countries such as Germany. So if you have a significant slowdown in China, that has implications for broader economies as well. What can China do in response? It can lower tariffs for other countries. It can placate the US by offering some sort of purchases. And it can continue to diversify exports away from the US. While I'm listing out the challenges, and before you turn around and say, my God, it all sounds really dreary, but there are always opportunities when things become more fractious in the world. Just like the last time in Trump 1.0, when people saw an increase in tensions between the US and China, and China exports to the US fell, other countries were able to grab market share. And we expect a similar phenomenon to happen this time around if there was further escalation in trade tensions. We expect countries like Vietnam, Mexico, Taiwan, Thailand, Singapore, all of these to gain market share, and that will support their growth stories. Actually, if you look at the FDI flows, then you can see that there's been a lot of investment even into GCC countries and the CEE economy, Central and Eastern European economies, especially Hungary, where people are setting up base production units and trying to export from those areas. And what I find very interesting is across the conversations we had last week, that echoed something that we have been kind of following for many, many years now. We've run this survey of about 200 firms based in the manufacturing firms based in the Greater Bay Area region of China. And we've asked the same question repeatedly over the last 11 years to them. Are you planning to leave China? If so, why? And where would you like to go? 11 years ago, the answer used to be, we're not really looking to leave China. We are concerned about rising labor costs, but we are still happy to stay in China. Our latest survey, which came out in 2024, and this is a proprietary survey, as I said, this shows a very different landscape in which these manufacturing firms are operating. About 50% of the respondents said that they are actually being impacted by fears of tariffs, by the need to maybe have another base, Western companies demanding that they have a base outside China. So none of them are really looking to move out of China or exit China, but all of them are very strongly pursuing a China +1, or even in some cases a China +5 or 10 strategy, where they're looking for an additional production base. And what we found is that for most of these economies, for most of these manufacturing firms, again, the ASEAN economies come out as the most relevant when they're looking at where they would like to go. But increasingly, CEE, GCC countries are also looking more important. So overall, really two key themes to discuss. What happens with the Federal Reserve? Will it be able to cut rates or not? Whether the US fiscal policy and trade action might be more inflationary and constrain the Fed. And the second theme is, what will the US administration do in terms of its trade policy, and what are the reverberations felt over the rest of the world? Tying it all together, in terms of trade, the IMF expectations are that trade is pretty much in line with global growth of about 3% this year and next. But clearly, as was mentioned earlier by Abhishek as well, there are risks in terms of geopolitics beyond just what's happening on US trade. There are upside and downside scenarios that we can see. The recent truce that we've seen is quite encouraging, and that might help reroute some of the trade that was routed around the Cape of Good Hope. But clearly, there are still risks that there's a further escalation in tensions could continue to make these maritime choke points a source of concern for the international community and also for inflation. And finally, what's really interesting to me, and I would love to hear, I'm really looking forward to hear all of you having a more discussion on what's happening on shipping, because I feel shipping is turning out to be like more of a harbinger of what's going to happen. And we're really looking at it more carefully to see what the trends are. Because recently, shipping costs went up over the end of December and January, but particularly for the US routes, Asia to US routes. And we wonder whether that's really a reflection of front-loading of shipments to avoid some of the tariffs that might be coming through. And I would love to hear more discussion on this and hear your thoughts on it. But clearly, some of this action is leading to higher shipping costs, which then obviously feed into everything else. For most of the other routes, shipping costs have not really moved that much. So I'm going to end the presentation for you on this. A lot of challenges, but also a lot of opportunities for different markets. And we look forward to hearing a little bit more from you on what you think is going to happen on the shipping front. Thank you so much for your time and attention. Thank you.